Hello, Alex Cole, and welcome to this May 19th episode of GoNoGo Charts. How are you doing, my friend?
Good morning. I'm doing all right. How are you?
I'm doing okay. Really heavy day in the markets yesterday. Probably surprised some, but we're in no-go trends, right? Lower highs, lower lows, much to be expected in that direction. Why don't we dive in right away to the cross-asset heat map, looking at the absolute trends across the global asset classes. What are you seeing?
Really bad day yesterday. But like you said, I mean, we are in a no-go trend. So we are down on the week, back to sort of the lows from last week on the U.S. domestic markets. SPY is in that top panel. And you can see that trend strength in the upper panel, the strong purple color of the map. Treasuries, bond prices, of course, not yields, still in a no-go as well, but have rallied a little bit today. Commodities still in a go trend. The dollar still in a go trend, weakening a little bit, though, coming back to some support. And Bitcoin still in a strong no-go as well.
Absolutely. Logical to expect a little bit of mean reversion, snapback today after the harshness of the sell-off yesterday. But that's the nature of our markets right now. We're seeing no-goes across equities, bonds, and of course in the cryptocurrency markets. For those still running modern portfolio theory, 60-40 split client portfolios, I really feel like the financial advisor network needs to be paying attention right here when those correlations move to 1. Can't hide out in bonds anymore, folks. Let's shift away from the cross-asset heat map. Let's look at the sectors of the S&P 500 on a relative strength basis. So again, we're applying the GoNoGo methodology to each of the sector ETFs relative to the benchmark. So each of the sectors divided by the index as a whole. The story looks the same to me, Alex. Anything changing and catching your eye?
No, very simple picture. The growth sectors underperforming along with financials, and then everything else relatively outperforming. Now, that doesn't mean they're in go trends necessarily, but relative outperformance from things like staples, utilities, healthcare, materials, industrials, and you've got that real lagging underperformance bringing the market down from technology, discretionary, communications, and of course financials as well.
Absolutely. Consumer discretionary sector down almost 7% in yesterday's selling. And again, these are relative trends. So we're looking at the overall market in a sharp downtrend. Underperforming a downtrend means that our loss leaders are right up in those top 3 panels. Looking at financials as well. Alex, let's look at the price action itself in the S&P 500, moving away from that asset class GoNoGo RelMap, and instead just looking at a plain GoNoGo trend chart. My eye, it seems to look like a series of lower lows and lower highs. What are you seeing, Alex?
Yeah, absolutely. We are in a strong no-go trend on the S&P 500. Strong purple bars even today down as well on the S&P. We've been rejected by the zero line. Like you said, lower highs, lower lows. Not a place to be at the moment in the S&P 500.
Interesting to see the GoNoGo oscillator there in the lower panel, testing that zero line, that level of neutral for our momentum readings, and getting rejected there, finding a lot of resistance. Talking with Jay Woods on the floor of the New York Stock Exchange last week, he was saying that there's so many analysts looking for that bottom, looking for signs of capitulation and perhaps an end to the selling. Obviously, a day like yesterday where correlations move to 1, hard sell-off might indicate that for many analysts who are looking for that bottom. And I think what's great to point out here is that we're not predicting, we're not future forecasting what the markets might do. Instead, we're obeying and responding quickly to what the markets are telling us. So when the GoNoGo charts hit that no-go back in April, we really just want to be out of this market until it's guilty until proven otherwise. And so those bear market rallies that are so tempting, we want that selling to end, want to get back in. It's very easy to bulk up, to find analysts who are recommending taking long positions as those rallies are so tempting. But we want to look at the weight of the evidence, that combined blended technical indicator in that top panel. blending everything that we've known and loved, and that's been a part of a trend checklist for many of the big PMs that we work with. Alex, moving on from the S&P 500, financials are a sector that, for a long time at the start of 2022, a lot of speculation about a rising interest rate environment benefiting the financial sector. What are you seeing from a trend perspective here?
I think that took a lot of people by surprise. It doesn't always play out that way. And so the financial sector itself, the banks have not been doing well, and we've seen this no-go trend really strengthen. We see lower lows. This resistance level that's on here is on here from a period a while ago, which we'll see on a weekly chart in a minute. But we're seeing a no-go trend continuation icon at this resistance and price rolling over. The no-go trend is strong. The oscillator's been rejected by the zero line again. So financials really continuing to struggle.
Absolutely, and multiple time frame perspectives are so helpful. If we bounce this out to a weekly view, and we can see where those important key levels of what would have been support for the financial sector, seeing that no-go trend having the strength and durability to bust through to the downside, potentially signaling even further evidence of a no-go trend.
Right. We see this concept of polarity that we talk about a lot, something that was resistance, then becomes support, then become, support again. And then that's what we're looking for here as price trades down to it. Should it find support? It did, but we were concerned here because of the break below zero on the oscillator. As it comes back up and retests, then we see the trend change. And then this time was able to break through that level on heavy volume, as you can see how strong the no-go trend is in the financial sectors on a weekly basis.
Absolutely. And so if we were to dial into the financial sector, look at a single security within the financials infrastructure, let's take a look at Bank of America, BAC, and see how that's faring relative to the index itself.
Very similar picture on a weekly chart. I think if we go into a daily chart, that's what we sent out earlier this week. And we were talking about how we'd seen this no-go trend continuation icon. And so we're therefore expecting further downside pressure and perhaps a move to new lows. And this is where we are now. We are at a low in price, a strong no-go bar, oscillator moving back lower into negative territory. So a really bleak picture for one of the largest banks.
Absolutely. So with GoNoGo Charts, Alex, if we wanted to participate to the short side, right? So we're a long short equity fund manager. Talk to us a little bit about the icons that they're going to see in a no-go trend and how that correlates to the GoNoGo oscillator.
Yeah, so we know how important the zero line is. If you've watched the show for a few times, or if you've seen us present somewhere, we know that when a trend is in place, momentum should largely stay in the direction of that trend. So back here in February, when we saw the no-go first identified, we know that the weight of the evidence now suggests we're in a downtrend, a no-go trend, having been trying to maintain this go trend until that point. Once that happens, we look to the oscillator, and every time the oscillator gets turned down from the zero line, we're going to be able to suggest that momentum, bearish momentum, has come in the direction of this no-go trend. And so this first time this happened here, we saw a surge of momentum into negative territory. That's when we get the no-go trend continuation icon. So we're saying no-go has been identified. Now we're saying there's a continuation icon because we've seen momentum strengthen in the direction of the trend. And as you go through this no-go trend, you see these opportunities to enter or to participate or to scale into positions based on the fact that we can say quite confidently that the trend is in place, the no-go trend is in place, and momentum has now resumed in the direction of the trend. So negative momentum has resumed every time we see this red circle.
I think technical analysis gets a fairly well understood characterization as a strong risk management discipline. We were just at the CMT Association Symposium. We've talked to a lot of our clients, and they use GoNoGo charts and technical analysis broadly to help them manage risk. If you're watching financial news media, you've seen more technicians hitting the screens in this last quarter than we have in the last couple of years collectively. And the reason for that is on a fundamental basis, it's impossible to tell somebody where the bottom is in. That's really a sentiment mechanism, and technicals help you on a risk management perspective. However, as Frank Teixeira likes to highlight, and many other long-term portfolio managers, technicals really help you lean into positions that are working for you. So trends persist either to the upside or the downside, and we want to participate in the meat of the move. It means we want to be patient investors and stay with a trend. So if we had a short on here for Bank of America, we want to know that we could even scale into that position or stick with it at a minimum when we see momentum resurging in the direction of the trend. That's the purpose of these tools, is that it allows us to, as they say in Bull Durham, play with fear and arrogance, right? We have responsible, tight risk management, but we also can lean into the positions that are really working. So those trend continuation icons are going to be our signal that there's further downside and we can stick with a short. Alex, tell us just a little bit about those green triangles, the counter trend correction arrows.
Yeah, so that's then looking at the oscillator in a more traditional sense. We know that when an oscillator goes to an extreme level of overbought or oversold, there is a possibility for it to mean revert, right? These oscillators generally were created in the 70s when markets moved sideways. So you did very well if you found peaks and troughs. And so with the zero line, we're able to use the oscillator within trend. But the traditional way to look at an oscillator is to say, look, it swung very quickly in one direction. Price velocity has been extreme in one direction. So we may see a correction against that move. And so what we're looking at when we see these counter trend correction arrows is a situation where price has moved very quickly in one direction, and then we see momentum cool off and come back to neutral. And that's going to tell us that in the short term, doesn't mean necessarily that the trend is over, because we'll look at the bar color for that. But in the short term, price may struggle to move lower. It might correct against the trend. And so whenever we see this oversold momentum coming back into neutral, that's what tells us then that there may be some tough times ahead for the trend to continue in the direction that it's in. Now, of course, sometimes, as here, really didn't get much of a counter trend correction, just a few bars sideways before the trend continued. So oversold is not necessarily a signal when in a downtrend that prices may rally, but it just shows you that price momentum has been extreme and has cooled. And so you may see a few bars of consolidation or correction against the trend.
Absolutely. I will never forget the way Ralph Acampora characterized overbought and oversold. And he said, Tyler, you don't just buy anything that's oversold. You wait for that condition to end. He said, think about a beach ball and you submerge it underwater. Like, if you let go and that beach ball stays underwater, first of all, where the hell did you get that beach ball? But also that there's something clearly wrong. If it remains in an oversold condition, that's information in and of itself. Alex, thank you so much for that explanation. We got to turn to some headline news, right? Elon Musk always gracing our Twitter feeds and our newscasters. Seems to be toying with the board. Who knows what all of that melodrama is that's playing out? But if we look at the price chart of Twitter, we could see that what seemed like the golden age of Elon taking the helm and taking the organization private may no longer be the public opinion of Twitter. And we know that the consensus view on what Twitter is worth is revealed in price. And so I see a no-go trend. What are you seeing, Alex?
I love this chart because this chart to me, I think keeps me honest and tells me how to use the tools and reminds me how to use the tools responsibly. So we've been talking about Twitter for some weeks now, and we were talking about how the picture was very bullish. We didn't know why. Here it went to a go trend. This is when Elon announced that he was.
That's when he first assembled the 9.5% position in Twitter.
That's right. That's right. Yep. So we didn't know that was going to happen, obviously, but the trend was already in place. Momentum was above zero, and then I was looking at it here as one of my favorite setups is when a go trend's been established. There's been a counter trend correction, and then you get a go trend continuation, meaning that the momentum has found support at the zero line. So this was, for me, this is a really strong setup. Now, we were able to stay in a go trend. We got more go trend continuation icons, but we didn't make serious price gains from these levels over here. But what reminds me about the power of the weight of the evidence approach, and by combining these tools in terms of price trend, momentum, and all the rest, is that right here we were given an indication that the trend was not healthy, this break below zero on the oscillator while the Go trend was weakening to aqua bars. Now, at this point, from technical analysis research, I know that if a gap doesn't provide support, then the gap is most likely going to be filled. So that's what then happened as we tested that gap the next day. So this was sort of the first area of concern. Now, even if you held on through this cause of worry here, but then you saw the no-go bar at the bottom of this gap, then that's sort of the final piece saying, okay, not only now have we lost momentum, failed to find support at zero, but now the trend has changed to a no-go. So I think on Monday, we were talking about how this no-go was happening at this level of support. And then you can see how the trend has strengthened now into no-go territory with purple bars as momentum has really, really gone into negative territory. So just sort of a nice way to remind myself that there is risk control built into these tools.
Absolutely. And it's, the great trend following investors like John Henry who say you have to take the emotion out of your process, the would be or the could be or this should be. I know Dave Keller talks about those dangerous words all the time on the final bar, that we're not looking for what should happen or trying to predict where the market is headed. Instead, we want to react responsibly to what is being shared with us. So thank you for that, Alex. We're in a no-go on Twitter. Let's change the mood of this. There are some things that are working. I know you love that Jimmy Buffett tune. It's 5 o'clock somewhere. There's a bull market somewhere, and it's certainly not in tech stocks. Let's check in on Exxon Mobil as that has resumed the uptrend in the note that went out to all of our subscribers on Monday, talking about continued momentum resurgence in the direction of the trend. Let's tell me what you're seeing from a trend perspective.
This is what we were seeing on Monday. We'd noted this, multiple Go trend continuation icons. We noted how, the Go trend that's been a really strong trade since the beginning of the year flirted with these Go fish bars. And we even saw the oscillator dabble with barely negative territory. But once it got back into positive territory, the Go trend back in place, we were seeing these Go trend continuation icons. And what we were looking at on Monday was how it had corrected again, oscillator driven back to the zero level, but had found support. And so this was where we were on Monday, and it looks as if we've put in a barely higher new high. The trend has strengthened to bright blue bars, so trend still in place and looking to be quite healthy on Exxon.
In a recent episode of the CMT's podcast, Fill the Gap, with Ian McMillan, he was talking about how the first thing they have to do with clients is explain their process, explain the methodology, and that he might buy in repeatedly to a trade that's working, but of course things get whipsawed. So when I see a chart like this, if we've been participating in the oil trade throughout the whole year, when we get to that late April neutral bar and we see momentum below zero, that might be enough. We might take a more aggressive exit, get out quickly, and there's no reason not to re-enter the trend on a fresh go as momentum comes back above that zero line. Again, heavy volume, and then we see a trend continuation icon. There's no shame in getting out of a position to manage your risk and then getting right back into that same trade if indeed it reverses and the trend continues. So just wanted to point that out for folks, that GoNoGo charts can be used in really depending on your risk tolerance. But moving to that neutral territory with an oscillator below zero might be enough to exit the trade for a lot of folks. So thinking about things that are working, Alex, let's turn to another favorite commodity of ours, wheat, that has just been skyrocketing. I saw a stat yesterday, about 151 million net inflows into this fund, the wheat fund from Tokrium, just this week. And so we see a lot of institutional investors shaken out of that 60-40 portfolio, equities and bonds not working, and looking to add to commodities positions. What do you see from a trend continuation perspective?
Well, I think there's no doubt that there's a lot of people that think this commodities trade is going to be in place for several years even. So moving that money around doesn't surprise anybody. The amount, though, that was quite massive this week. So good to see if you're on the side of this trade. But you can see how the Go trend has been in place for several months. And you can see these Go trend continuation icons coming in through the middle of this period. Now, that parabolic move that we saw in March we are just about back there, and we saw a long sideways move. But look how the Go trend stayed in place. The oscillator primarily stayed at 0 or above, and we've had a nice run back up to test those highs. Now, we didn't break above those highs. We saw a counter trend correction arrow actually here to tell us that in the near future, we may struggle to go higher, but we're going to watch to see this oscillator get back to 0. And if it finds support again at price levels that are higher than they were back here, wouldn't be at all surprised if we see an attack on these prior highs.
Absolutely. Obviously, our commentary about these trends is specifically as investors, we want to be participating in trends to the upside. Obviously, the inflation that has been really difficult for a lot of countries around the world, and consumers facing really difficult times both at the pumps and at the grocery store. That's certainly not what we want to see. The backdrop of a strong U.S. dollar, rising rates as Treasury bonds sell off, and then of course higher oil, really kind of a triple threat that's going to cause headwinds for the equities markets broadly. But Alex, if we can, let's do two more quick examples for folks just on how they could think about the life cycle of a trade. Let's pull up a chart of Target. Near and dear to my heart, born and raised in Minneapolis, Minnesota, the home of Target and the Dayton Hudson Corporation. Nobody could have, perhaps there are people, analysts on Wall Street, that could have told you there would be a 25% sell-off yesterday in Target. But I think what's important to look at on these charts, as that Go trend came to a conclusion, we saw momentum break below 0 and then strike a no-go trend. So from a risk management perspective, we do not want to own no-goes. Potentially that reverses, momentum hit an oversold condition, and then maybe the trend continues. Great, we can buy back in. But what we want to know about these no-go trends is that nobody can forecast where that bottom is, and so we do not want to be involved in no-goes, as the herding mentality of investors has shown us there can lead to much steeper losses. Anything that you would want to see from a constructive standpoint, Alex, to know that this is ready for a mean reversion, or what would you need to see on this chart to get back involved in something like Target?
Really, anything that's not what you're currently seeing. I think that, you talk about buying bear market rallies, and you talked about how earlier, even in this show, you talked about how it's not a surprise that some markets are rallying today after yesterday's terrible day. But again, you also talked about Ralph Akampora's example of the beach ball. If it stays underwater, you're in real trouble. And, look at Target today, down again. So there was no bounce back from yesterday's move. So there is something wrong, it would seem, with Target stock prices. And so right now there is nothing to suggest trying to get in at the low at this point. You would, at the very least, first thing you would need to look at is oscillator getting back out of the extremes of oversold, and then you might get a short-term counter trend correction green arrow. Then, of course, we're going to watch as the oscillator rallies to the 0 line to see if it finds resistance there. If it's able to break back above 0, then we'll watch the price trend to see if it can get back to some sort of Go colored bar. But there's a lot of things that would have to happen before you would start to get excited about Target.
Absolutely. Very well said. The other example I wanted to look at was just Walmart, another retailer that has been really beaten up this week. And again, the evidence of a no-go trend long before those gaps down. And we're just seeing continuous selling in these names. What is the most likely thing to happen after a stock is down 60%, Alex? Gets cut in half. That's the most likely thing that will happen.
Yeah, it's nice to see charts where things where you get given opportunities to make the right decision. And I think that's important. Like, you talk to clients all the time, and they knew or they thought, but they didn't act. And I think when you take the subjectivity out, you take the emotions out, and you use technical analysis, whether it's GoNoGo charts or just a really strong disciplined process, you have had several opportunities to make the right decision over the course of the last couple of weeks regarding Target and Walmart. The first being that you had a break below 0 in momentum, and you know that in a healthy trend, 0 should act as support. When it doesn't, then you're worried. You see the continued weakness in the trend indicator. You see the oscillator retest 0 and get turned away. Now you see heavy volume coming in on this selling, right, as the momentum stays negative. And then you get a pink no-go bar, and then you get a purple no-go bar. And like you really should have been out of Walmart from a technical perspective. And so I think it's always nice when you see that your process gave you opportunities to do the right thing.
Absolutely. Very well said, Alex. And for all of you who are watching this on YouTube, thank you so much. Hopefully you're subscribed to StockCharts TV and give this one a thumbs up. But you can also check this out at StockChartsTV.com. And you can watch the GoNoGo show every Thursday afternoon at 3:30 Eastern on demand, wherever you take your mobile device. I also wanted to invite you all to join us for a long format educational workshop on June 15th. Alex and I are going to talk about how to beat the benchmark. We're going to look at relative strength concepts, what's happened through the first half of this year, and things that we're keeping an eye on through the end of 2022. Thank you all so much for joining us. Stay safe, be well. We'll see you again here next week. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.